This analysis looks at BigBear.ai's Q3 earnings surprise, a $2.5 million net income, and the simultaneous massive acquisition of Ask Sage.
Yeah, this was a really strong piece of work. It gets right into the nuance and doesn't just, parrot the headlines. Our goal here is just to make sure the presentation is as sharp as the research behind it.
Okay, let's dive in. The first point is about framing. There seems to be a real disconnect between that high-impact title, BBAI from loss to profit, and the very sophisticated analysis inside the report.
That's it, exactly. The overall analysis report's credibility and robustness are undermined by the sensationalist framing, which conflicts with the report's own deeply nuanced financial findings.
But why is that so damaging? I mean, the market did react positively, didn't it? The stock jumped.
It did, but the weakness here is that the title and the opening, using words like bombshell, they prioritize the market shock.
The shock of that $2.5 million profit figure.
Right. And when you promise a shock, the reader, especially a sophisticated one, expects a real operational victory. But the report itself shows the profit came from accounting adjustments. So for a technical reader, that high-energy tone, it just feels like a misdirection right from the start.
Wait, let's pause right there. You said non-operational accounting adjustments. The report mentions a $26.1 million non-cash derivative revaluation gain. Can you break that down? Why is that different from money BBA actually earned?
That's the crucial distinction, and the report needs to make it sooner. Essentially, that gain it's an accounting artifact. It's related to their convertible debt.
So not cash?
Not cash at all. It means their paper liabilities went down in value, which creates a non-cash gain on the income statement. It has zero impact on the actual money the business generated. It's a technicality that just happened to flip the net income from a loss to a profit.
And by leading with the profit, the report implies something that isn't really true about the health of the business.
Exactly. So the suggestion isn't to be less exciting, it's to be more precise up front. We need to calibrate the tone to focus on the strategic shift and the real operational story.
So treat the net income number as the hook, not the thesis.
That's the perfect way to put it. The analysis needs to prioritize long-term accuracy over that short-term shock value.
So what does that look like in practice? Give me a concrete example.
Okay, one way is to just rephrase the title. Make it signal the complexity immediately. Something like, BBAI, $26 million accounting gain masks 20% revenue dip. Is Sage the only path to profit?
I like that. It's still punchy, but it shows you understand what's really going on.
It respects the reader's intelligence. Or, look, if you really want to keep that high-impact title, you can. But then the very first paragraph has to do the heavy lifting.
It has to have that caveat.
Immediately. You have to explain that the profit is due to that non-cash gain. You set the stage properly, and then you can talk about why the market reacted the way it did.
That makes a lot of sense. So if the profit is an accounting mirage, let's talk about the operational health. This leads to the internal structure of the financial discussion.
Yes, and that brings us to the second key point. The report currently buries the most crucial operational data points, which diminishes the strategic significance of the subsequent Ask Sage acquisition.
And why is the order of information so important here? Don't you want to lead with the good news?
The weakness is structural. The report correctly identifies the profit, yes, but it doesn't give enough weight to the operational reality. We're talking about a 20% year-over-year revenue drop.
From about 41 million down to 33 million?
A huge drop, and a negative adjusted EBITDA of $9.4 million. By focusing on that non-cash gain first, the report makes this operational burn feel like a footnote.
Okay, let's dig into that negative adjusted EBITDA. You're saying that's the number that really matters for an investor trying to see the true picture?
It is absolutely the true tell. Adjusted EBITDA is a proxy for operational cash flow. It's the money the company is making, or in this case, losing from its actual business.
Right.
So a negative $9.4 million means their day-to-day operations are burning through almost $10 million in cash that quarter. That's the number that shows the business is operationally shrinking. And that should be the core reason they need a big strategy shift.
I see. So if you frame it that way, with the revenue drop and the cash burn up front, the Ask Sage acquisition stops looking like an opportunity and starts looking like a necessity.
An absolute necessity. That's the suggestion here. Restructure the deep dive to show the difference between accounting profit and operational health. You have to lead with the challenge. Lead with the negative EBITDA and the revenue drop.
You want the reader to feel that pressure.
Yes, feel the pressure of the core business shrinking before you introduce the $250 million solution.
So how do you do that? How do you create that linkage?
It's about narrative flow. Instead of talking about the revenue decline after the profit, you open the financial deep dive with it. Start with the 20% drop. State the cause, lower volume on old Army contracts. That creates a vacuum.
And the acquisition fills that vacuum.
Precisely. You can even pose the question directly in the analysis. Ask something like, if adjusted EBITDA shows a $9.4 million operational loss, how does the $250 million acquisition of Ask Sage directly combat this problem? It creates this powerful story where the acquisition is a necessary intervention, not just good news.
That's a great transition to the third critique, which is about the acquisition itself. The analysis presents it as a game changer.
It is, but we can go deeper on why. The discussion of the Ask Sage acquisition needs to transition from simply listing its benefits to establishing its necessity as a direct counterbalance to the operational decline.
So the current weakness is that it's framed as BBAI playing offense, adding about $25 million in recurring revenue, which is true, but it misses that deeper connection to the 20% revenue hole we just talked about.
It does. It misses the strategic brilliance of it. The analysis establishes the problem, right? Reliance on older Army programs.
Right.
So the solution needs to be framed as a direct, targeted defense against that specific weakness. They aren't just buying growth. They are buying modernization and risk mitigation.
So the suggestion is that BBAI is using its massive cash pile, that $456 million, not just to get bigger, but to literally replace a part of its shrinking core business.
That is the essential insight. You have to leverage the specifics of Ask Sage. It's a generative AI platform for government. It's secure enough for the Pentagon. It has over 100,000 users. BBAI is buying a targeted solution to modernize its offering and fix its client weakness.
That really changes the angle. It moves from what they bought to why they had to buy it.
Exactly. The report should connect the dots. Use the $456 million in cash as the weapon deployed to fix the 20% revenue hole. It makes the move a strategic necessity, not just an opportunity.
How would you phrase that to give it more punch?
Well, instead of saying something generic like, this combats the declining revenue, be more specific. Try something like, the Ask Sage acquisition is the $250 million countermeasure to the reliance on older Army contracts. Its specific strength in generative AI provides immediate diversified revenue that those older contracts were failing to deliver. It links the cost directly to the problem.
And you can use the market's reaction to support that idea too.
Absolutely. Use that 12-20% stock surge and the analyst upgrades to show that the market gets it. The market understands BBAI is using its cash advantage because its core business is under pressure. That elevates the analysis from just reporting on an event to explaining the existential reason for it.
And that provides real value to a reader who already knows the basic facts. It's a clear path to making the arguments much, much stronger.
The hard work was already done. The operational truth was uncovered. Now it's just about telling that story in the most compelling and, frankly, the most honest way.
Okay, so to summarize the feedback here. First, we focused on reining in that sensational tone to match the sophistication of the analysis, especially by being upfront about the non-cash gain.
Second, we said to prioritize the operational reality. Lead with the negative adjusted EBITDA and that 20% revenue drop to really establish the core problem first.
And finally, framing the Ask Sage acquisition not just as a good move, but as a necessary, targeted $250 million solution to that exact operational weakness.
The foundation of this analysis is incredibly strong.